Good morning, everyone. I wanted to shoot this quick video to talk a little bit how I plan to use margin in my approach for the brokerage account. I don't use margin in my retirement accounts, like I've kind of said already. I do use the risk metrics to let me know when's a good time to buy. Like I said, if you have, HSA, a family HSA, and over 8,000 to invest, some will just invest all eight right when they first can. I'm a firm believer of kind of stacking it throughout the year. One, it lets me kind of budget for it in my paychecks, which works better for me and my wife. The other thing it allows me to do is to buy the dips. And what do I mean by that is if you look over here, when the risk metrics went back down to, 0.58, that's a good opportunity. And I deployed a lot of capital into the stocks that I buy. And the good thing about that is it allowed me to get a better price. It took the idea of me thinking about things, too much. Overthinking, but then also I gained that price appreciation. It really snapped back because that was with the tariff in, the tariffs to everybody, really. Um, but what I plan to do with the margin is I plan to use the same dynamics. And the reason I have these tabs up here about Robinhood and M1 is originally I was going to go with M1 Finance because they have better margin rates, but Robinhood just recently added closed-end funds. I really like CLM and CRF. I invest; those are really the two big dividend stocks that I look at. They pay about 20% a year. And I'll make a video about that because it's about the rights offering and how you have to play it in order to successfully be able to manage that. So I will talk about that in future videos. To me, I think the yield and also playing the rights offering makes sense just from a ROI standpoint. So really, what I want to do is use the margin as I build my account. Let's say I decide to go to $2,000 to $3,000 between the zero point 0.7 and zero point 0.8 wristband. And then if it goes anything above a zero point 0.8, I'll stop buying. Right now, I think it's at like a 0.788. So I'm still within that band. So if I were to get paid, I would invest it at that time. If it drops below that, let's say a zero point 0.6, I most likely will add more money. So maybe 2,500 or 3,500, whatever I decide on, and dynamically DCA in. The good news is as my portfolio grows, and let's say the market drops further, I will be able to add more money to it. So either having money in a high yield savings account. I talked about gold and silver being something I'm interested in buying. So essentially being able to really stop looking at the stock market and buy something different, as far as assets go. So this video is going to be about using margin, and that's really kind of how I plan on using it. Is as the market goes down and my account grows, it will become more purchasing power. I'm not going to do this in my saving or my retirement accounts. Again, I just use the DCA model dynamically. I throw money into it and buy according to the risk metrics throughout the year. Um, and that's how I'm going to play the retirement accounts. So we looked at this chart a few days ago. This is days in the bands. So looking at here, the best time really to kind of DCA into the market is in the zero point 0.5 to the zero point 0.7. The bell curve, kind of looking at the standard distribution, it makes sense that this would be the where the market kind of hangs out the most. If we go down to the zero point 0.4 and even the zero point 0.3, we don't spend as much time down there. So if we go back to the risk metrics, the last time we hit the zero point 0.3 would have been in 2020. I think this is the COVID crash. And people know that if you would have invested in the COVID crash, you would have been able to make substantial gains. I mean, you're talking about right here all the way to the top. And, I think as we start experiencing more political turmoil, election chaos, tariff chaos, the next crash, the government's going to have to turn the printers back on. So since 2008, when we kind of made that a policy down here, anytime there's a crash, the government steps in. So in my mind, I'd rather have my money invested in something that's going to be saved versus a savings account that's only going to give you 4%. But it went all the way down here in 2008 to the zero point 0.2 risk metrics. So if I see another opportunity to buy, in my lifetime, hopefully, I will be able to kind of buy the farm, if you will. Because in my mind, if we get down here, and I remember with COVID, a lot of people were like, "This is it. We're going to shut down governments. We don't know really what's going to happen." And in my mind, it's a risk. So I rather put more money into the market, hopefully that rebounds. And what's the alternative is doing nothing. So that's why I kind of use the strategy is only invest what I'm comfortable with, but being able to kind of still be able to capture the upside. So that time in the wristband is really important. This is only 860 days we've been at that. And a lot of times it's just like, the huge drop and you have a few days to recover looking at the risk metrics. I thought this is interesting. Cowen actually has the bear markets as far as return on investments. I'm going to make another series about Ben Cowen and also into the cryptoverse. Like I said, in 2020, I found Ben, and this is really the biggest catalyst for my investment decisions, not only in Bitcoin, but also the S&P, and also Bob Lucas looking at cycle theory. So if you could see, like 29 obviously was one of the biggest crashes. 37 lasted a long time as far as the ROI goes. This was more of the flash crash. This is more of a drawn out year. And that is from 37 to 42. So over 5 year span, where this one is only a 3 year span. So if you kind of look at the dot-com bubble, that's the closest that we've kind of seen, since 1946, as far as what it kind of looked like. Even the 2008 crash. So looking at here from 2007, 2009, the ROA dropping as far as the number of days, but also the ROI just to the bottom, right? But then if you look at the bull markets, we've seen a lot more bull markets since then. From 2009 to 2020, this is the biggest bull market that we've kind of seen in our history, right? So then we had the stock or the housing crisis. But for me, looking at kind of what we kind of have done, I rather participate in the upside. That's why I'm not selling anything. I think just psychologically, it's better for me just to add more money to it. But then you look at 2022 to 2025, even kind of looking at this one to 2008 with the financial or the housing market, this is right when we start introducing, call it money printing and QE, where the Treasury was adding to their balance sheets. So we see a huge reversal in the ability to have these bull markets. The other thing I wanted to say too is, oh, that's the one I really wanted to cover. 2020 to 2022, and then obviously you saw that decrease. Interest rates were raised. There's a lot of different things that kind of came off into that forecast. And then finally is the margin. I'm going to look at this too. I mean, this is what you need for the percentages. It's better than you're going to get at a bank. I'd rather negotiate my margin down. I know a lot of people have successfully done that. What you do is you add money to the brokerage, and then you give them a call and say like, "Hey, I really want to invest more. Can we work out a deal where I get a lower margin rate?" I've known people that have successfully reduced their Fidelity accounts all the way down to like 5.5% margin. And the reason why I think this is going to be really lucrative is as they drop rates, so are the brokerage accounts. So that's all I really have for you today. I look forward to working with everybody, and thanks for watching my videos.